Okay guys, so we're going to talk about Insurance 101 today, okay? Now, has anybody ever told you how insurance companies work? No? Okay. Well, insurance companies have to adhere to two principles, okay? There's the first one that's called the law of large numbers, okay? And the second one, they have to be able to make a little bit of money, right? So I think we all kind of understand this one. Insurance companies have to be able to make money. They've got to be able to keep the lights on, pay their employees, and they have to be able to provide a death benefit to your loved ones in the event that you pass away, right? So would you want to work with an insurance company that wasn't making money or they were insolvent? No. Okay. Now, the law of large numbers works like this, okay? So, let's go with you, Cameron. Cameron, how old are you?
24.
24, okay. So at age 24, the life insurance companies are going to lump you in with 1,000 other, or actually thousands of other 24-year-olds. They know exactly how many of you guys are going to die this year, okay? And so when you turn 25 next year, they know exactly how many of you to the nth degree are going to die next year, and so on until you get to be much older, right?
Mm-hmm.
Okay. So as you get older, the odds of you dying increase, right? Okay. So let me explain then what a lot of my clients want with their life insurance. So they'll come to me and say, Ken, you know, I want a life insurance policy that's going to have a death benefit that stays the same the rest of my life, okay? And they can do that. So this is what that looks like. Life insurance companies will provide a death benefit, and they will guarantee that for the rest of your life, okay? But if the insurance companies are going to guarantee this death benefit and the risk of your death gets higher as you get older, what do you think has to happen to the monthly premium that you pay as you get older?
Increase.
Yeah, it's going to increase. So it's not going to kind of look something like this, okay? Now this is an example of what's called VGLI. If you're in the military, so VGLI will keep the same death benefit, but when you leave the military service, your premium will start out low, but eventually get really, really high. And you can see it's an exponential increase, okay? So what happens with this policy is you're going to get to be 65, 70 years old. Your premiums were way down here. Now they're way up here. It's probably not going to be within your budget to afford it anymore. What do you think you're going to do with this policy at that point?
Cancel it.
Yeah, you're going to cancel it. So is that something that you want to do? No. You want to be able to provide a death benefit for your loved ones. So a lot of my clients, just like you, will say, that doesn't work for me. I want a premium that's going to stay the same over my life. Okay? So that's going to look like this. The insurance companies will give you a premium, and that'll stay the same over the course of your lifetime. And they can certainly do that, okay? But if they're going to guarantee this premium over the course of your life, and the risk of your death is increasing, the insurance companies still have to adhere to these two principles, what do you think has to happen to the death benefit over the course of your lifetime?
Decrease.
Yeah, it's going to decrease. So it's going to look kind of something like this. It's either going to go in a straight line or it might even kind of stair step a little bit. But either way, the whole point is, by the time you get to be about 65 or age 70, your death benefit is now zero. Okay? You've been paying the same amount your whole life. You've been putting all this money into it. But now your policy is worth nothing. Is that what you want for your family? Right. Okay? A lot of my clients will tell me the exact same thing. I don't like that, Ken. So, what they want instead, well, they want a death benefit that's going to stay the same. Can't blame them for that, right? They want a premium that's going to stay the same over the course of their lifetime, too. But let me ask you, Cameron, can the insurance companies guarantee you a death benefit and guarantee you a premium that stay the same and still adhere to these two principles?
Yeah.
Probably not.
Probably not, right? Well, actually they can. There's a third component that they add to this insurance, and it's called actuarial reserve, or what's commonly known as cash value. So we're going to call it that going forward. So cash value is something that builds up starting at about 3 or 4 years in your policy, and it grows kind of slowly, but over time, it's increasing exponentially as well. Okay? So what we can learn from this is, as you get older, let's say this is the risk to the insurance company of you dying. Okay? You can see over time, this risk is what?
Decreasing.
Decreasing, getting smaller. All right? So this cash value is essentially something that reduces the risk to the life insurance company of your death as you get older and are more likely to die. Okay? Now, the great thing about this cash value is it gives you certain options later on in life that you don't have with other types of life insurance. All right? There's actually 5 options. We're going to cover those right now. Okay? So let's put some numbers to this. Let's call this a $400,000 death benefit, and maybe a $200 premium, and cash value at this point in time is, let's say, $320,000. Just want to throw some numbers. Completely made up, but they're probably about pretty accurate. So when you get to be, let's say, 70 years old, Cameron, you come back into my office. You know, we've been financial planning the whole time, and let's say things have not gone very well for you. Maybe there's another market collapse, you don't have all the investments that you wanted, and you need to keep this life insurance policy to protect your family if you die. Okay? So here's one option. We keep the policy, okay? But we keep the policy, you walk out my door, you get hit by a bus, all right? So what do you think happens to the cash value in this policy when you die?
You mean the benefit?
The cash value. What do you think happens right here? Where does that money go when you die? What happens to it?
To your family.
Well, what's going to happen is your family will receive the $400,000 death benefit when you die. Okay. The insurance company keeps this cash value because that is used to offset the risk of you dying. Okay. So that's a contractual amount right there. It's guaranteed in the policy. Your family gets $400,000, but the life insurance company keeps that. Okay. So think of it this way: he who has the financial risk of your death gets the cash value. Okay. So let's flip the script. Okay. Let's say you get older. You know, you're 65 or 70, and you got all the money in the world. You're good to go. You don't need this life insurance policy anymore to provide a death benefit for your family. All right. So you decide to cancel this policy. Like, I'm just done with it. I don't want to pay for it anymore. What do you think happens to this cash value at that point?
You get that.
You get the cash value. You cancel the life insurance policy, they'll write you a check for that amount right there, $320,000, make him payable to Cameron, and say, thank you very much for your business. Wish you the best of luck. So again, he who has the financial risk of your death gets this cash value. Okay? So we've covered 2 options that the cash value in this policy allows you to have. Keep your policy, or you can cancel your policy. We're going to talk about 3 more options. Okay? Now these options are only available for policies that have cash value. You can take out a loan on that amount. So let's say you get older, you want to retire, but maybe you need to take out money, pay off your house, fix a roof, start a new business. Okay? You can do that. You can take out a loan against this money, but it's a dual-edged sword. Okay? You'll have pretty good interest rates. That loan doesn't go against your credit, so the credit agencies never know. Okay? And it's a guaranteed amount you can borrow against. But most people who take out loans later on in life are typically in bad financial situations. They need that money to pay off debt or something else like that. And if you take out, say, all of that money as a loan, and then you die, what do you think happens at that point?
So,
What happens is if you owe a loan for that amount, the insurance company will subtract that from the death benefit that goes to your loved ones. So instead of getting $400,000, now your loved ones are only going to get about $80,000. So you can see how it's kind of a good thing and maybe a bad thing as well too. So that's one option that you have, but maybe not always the best option. Okay. There's another option that's called extended term. This option is what cash value allows you to have. And this is how extended term works. So let's say you come to me later in life again, but maybe it's not all unicorns and rainbows. You're like, the doctor just told me I've got 5 years left to live. I need to start making some plans, travel the world, whatever. So what we can do with your insurance at that point is called extended term. Okay? Essentially, your life insurance policy will stop, but it will continue for a certain term. Let's call it 5 years, 5 months, and 5 days. Oh, and by the way, you never have to pay a premium ever again. Okay? So you stop paying premiums, and your policy continues for a certain amount of time. That's guaranteed in your policy when you first get it. So you come to me, and the doctor says, I'm going to die, but you exercise the extended term option, but let's say you live for 5 years, 5 months, and 6 days. what happens at that point? What happens to your insurance policy? Yeah, it's done. All right. So your policy ends at this point. If you live one more day, you'll have no more life insurance. All right. So extended term is a good option for you if you know when you're going to die. Do you know when you're going to die? Right. Okay. So most people don't. So it's an option that you have available, but maybe not the best one. In my opinion, the best option available to you is the last one, which is called reduced paid up insurance. Okay, and that's how this works. So you get to be 65, 70 years old. Let's say you just want to retire, all right? You want to reduce your costs. You're like, I'm done paying for this life insurance, man. I'm good. Don't need to pay for this anymore. So you can stop paying your premiums, never have to pay ever again, and your insurance is a reduced paid up amount. Let's say maybe $320,000, and this continues, Cameron, for the rest of your life. Okay, so no matter when you do this, you can exercise this option. You'll have that amount of life insurance for the rest of your life and never have to pay a premium ever again. Okay, this is one of the best benefits that having cash value in a permanent life insurance policy allows you to have. Okay, and this is what we want our clients to do one day. You know, I'm a financial planner. I'm not an insurance salesman. All right, so at some point in the future, I want you to stop paying for life insurance. Okay. But in order to do that, you've got to be able to have this option for you later on in life. Okay, so let's talk about this real quick. Let's kind of summarize. So you're 24 years old right now, right?
Mm-hmm.
You're in pretty good health?
Mm-hmm.
Okay. Do you see any benefit to waiting to get your life insurance? Yeah. Here's why. So the earlier you get your life insurance, the more cash value you have in your policy, all right? So that means you'll have more of an amount available to you to take a loan. Okay. The younger you are when you get your policy, the longer your extended term will be available to you later on in life. And the younger you get your life insurance policy, the more amount you'll have available for a reduced paid up insurance. Okay. So again, is there any benefit to you to wait to get your life insurance policy? Right. So even if you wait 1 year or two, you might not even be healthy at that point. You might have some sort of disease that is already in you, but you don't know about it yet. You can't get life insurance if you have diabetes or cancer or something like that. So there's really no benefit to waiting. Now is the best time to get it. Would you agree?
Yes, I would.
Okay, perfect. There you go. So I kind of deviated from the script a little bit, but
It's cool. It's pretty smooth though.
yeah, it's telling a story.
Mm-hmm.